Today's episode of the Muni CreditCast will focus on the wildfires in Los Angeles County and their impact on municipal bond credit quality and investors. Before we start the discussion, on behalf of all of us at BAM Mutual, we want to express our sympathy and support for everyone directly affected by the fires, including the many municipal market investors, issuers, and other professionals in the region. If you have any additional questions after listening to today's podcast, please email us at ir@bambonds.com. Welcome back to episode 9 of the Muni CreditCast from BAM Mutual. I'm Mike Stanton, joined as always by BAM's Chief Credit Officer, Suzanne Finnegan. Suzanne, for today's episode, we're again going to turn to current events and discuss the wildfires that have consumed tens of thousands of acres in Los Angeles County, California. Over the past week, we fielded a lot of questions from investors about the potential impact on their municipal bond holdings, and we thought this would be a good opportunity to distribute those answers more widely and also talk about some of the characteristics about the California municipal bond market as well. Suzanne, I think a lot of the attention investors are putting on wildfire risk has to do with the fact that it feels new. Some of the neighborhoods impacted in Los Angeles have been there for decades, even a century, without facing this kind of destruction. So are these truly foreseeable events? Is this something brand new for municipal bond analysts like you?
Well, thanks, Mike. No, it is not a new risk in the market, but it does appear that these kinds of events are happening more frequently. And that raises the overall risk that a fire could strike in a heavily populated area, just like Pacific Palisades or the Altadena neighborhoods. And secondly, we have people living in places today that a generation ago would have been pure wilderness. Development and home construction are moving into areas that are designated as what we're calling the wildland-urban interface, or the WUI, so that a fire might have previously only damaged forest land, but now there are homes and lives at stake.
And so how are we looking at these things? I know that there's been a lot of development in terms of early warning analytical tools to help you spot wildfire risk. How comfortable are you with what you have?
Well, I think those tools are evolving as well. We do use a mix of both private and publicly available tools to evaluate the wildfire risk associated with credits. And we're not only evaluating wildfire risk, we evaluate the risk of a large number of natural hazards. We use a combination of those tools. The public tools are generally available from FEMA, called the National Risk Index. Also, there are tools with respect to sea level rise and things of that sort available from NOAA.
And so how easy is it to apply that data? Can you just go to the database, type in a zip code, and get a yes or no answer, a go or no go?
Well, I think there's a couple of factors that come into play. First, at the very least, you have to look at the risk from the lens of what is the specific transaction that we're reviewing and what is the credit structure. So size and scope matters. As serious as these fires are, their impact on the finances of, say, Los Angeles County, which has nearly 10 million people, is very different than the impact will be on some of these smaller communities. And the impact on a very broad credit structure is going to be different than on some of the very specific credit structures. And I know we're going to get into some of those questions in depth with some of our guests today. You know, BAM guarantees every bond we insure for the full life of the transaction. And so we spend a lot of time understanding how those individual and specific legal structures will behave and perform under stress.
So that's a great segue. Let's welcome our guests into the conversation. Todd Tomich, who's a Los Angeles native and has been based in BAM's West Coast Public Finance team for the last decade. And Mike Weinstein, who's been a guest before. He manages our surveillance team here in New York. Mike, Todd, thank you for being here.
Thanks for having us.
Thanks, Mike.
Mike, let's start with you for the current events. Your team has been monitoring the fires on a pretty much daily basis and how they've impacted issuers with BAM insured bonds. What can you tell us?
Well, as you said, Mike, we are monitoring the events in real time. And we can say at this time there's been no material impact on the credits in BAM's insured portfolio. No assets under BAM insured abatement leases have been affected, and no issuers that are primarily located in the immediate vicinity of the fires have been materially affected. BAM has insured approximately $3.1 billion dollars worth of bonds from issuers in Los Angeles County, which is less than 3% of our total insured portfolio, and more than half of that is from school districts with large, diverse tax bases that are not in the immediate fire zones. And as Suzanne said and alluded to, those issuers with larger tax base, geographic areas and tax bases are much more resilient in situations like this.
And it's a good time to provide a disclaimer. As we're recording this, there are still active fires in Los Angeles County. The Palisades fire and the Eaton fire have been largely contained. The Hughes fire, which is just erupted in the last 24 to 36 hours, is still burning, largely uncontrolled, although primarily in areas without development. And so we're continuing to watch all those things, and we'll provide an update if necessary and when relevant. So, Todd, let's take a step back. Mike mentioned abatement leases. That's obviously something that's important on his team's radar screen. Can you give us an explanation from a structural perspective what an abatement lease is and why it's relevant in a condition like this?
The bonds are payable from lease payments made by an issuer pursuant to a lease agreement under which the issuer will lease an essential building or property. The lease payments are designed to match the principal and interest payments due on the bonds. The issuer is required to make lease payments from any source of legally available funds and covenants in the lease agreement to include all lease payments coming due in its annual budgets and to make all necessary appropriations. Importantly, the issuer's obligation to make lease payments is subject to abatement in the event of the loss of use and possession of all or a portion of the leased property due to damage or destruction. Therefore, we spend a lot of time thinking about the leased asset in these abatement lease transactions. Location, age, and condition of the leased asset are important considerations. If a leased asset is destroyed by a wildfire, for example, the issuer can abate the lease payment accordingly. Since the lease payments are sized to match debt service on the bonds, any abatement creates a shortfall in revenue.
And so one of the ways that BAM protects itself is often in those situations you'll require property insurance on the underlying leased asset, but that may not be relevant in a broad destructive wildfire situation like this.
Yeah, the typical security package on an abatement lease transaction will require certain insurances to be maintained throughout the life of the lease agreement, and those are standard requirements that we require on BAM insured bonds.
So, Todd, what other bond structures are particularly relevant when you think about the impacts of a natural disaster on investors?
Special tax bonds are common in California. These bonds are payable from a special tax that is levied on a per parcel basis. The size of the special tax is independent of assessed value and is typically designed to repay debt service on bonds that were issued to finance the construction of infrastructure authorized by voters. Every special tax bond has unique characteristics, and we spend a lot of time reviewing not only boundary maps, tax base and taxpayer characteristics, debt levels, but we spend time reviewing the terms and conditions within the governing documents of the special tax bond. These are critical. The governing documents act to limit the amount, term, and application of the special tax.
I think that's really interesting, right? Because you mentioned that the fact that it's not necessarily related to property value, that takes one risk off the table, but in a situation like this, there are other risks that might be heightened.
That's exactly right, Mike. These are cash flow transactions. The amount of cash flow is limited to the terms of the governing documents on the transaction, and therefore we spend a lot of time analyzing the sustainability of those cash flows.
What about revenue bonds, where you have bonds repaid from the revenues, the operations of a specific asset?
Revenue bonds are common in California. For example, you see a lot of utility bonds, water utility bonds are a good example that are issued in California. The primary source of repayment on those bonds would be rates and charges paid by the users. Importantly, volume and consumption are key variables in the amount of revenue that's available to pay operating costs of the utility, but also pay debt service on bonds. In an example where a hazard has impacted the amount of use of the utility, for example, homeowners using water at their homes, that will have a negative impact on cash flow available for debt service and to pay operating costs of the utility.
So, Mike, turning back to you and the BAM portfolio specifically, what kinds of revenue bonds have you been monitoring and what have you learned?
Yeah, so as Todd said, we have insured several types of revenue bonds, primarily utility bonds. So we have certain water systems, bonds issued by the systems of individual cities within Los Angeles County, and we've been monitoring those closely. To this point, none have had any material amount of property or users directly affected, but that is something that we are closely monitoring because, as Todd said, if there are impacts to the user base or usage, that would directly impact could directly impact the financial performance of those systems.
And one of the things I think is worth noting here is that BAM Insurance pays principal and interest on time when due. So one of the risks that I think investors we don't talk a lot about in the market is the risk of kind of a temporary impairment. The idea that there might not be revenues in a given quarter or half year to make a bond insurance payment. BAM would step in and make that payment. The system could then recover as long-term rebuilding goes on, and the bonds can be recovered. The payment can be recovered by BAM, but the investors will be made whole all the way through the life of the deal.
Yeah, I think that's important to note, as well as the fact that most utility systems operate with a decent amount of reserves and liquidity in the normal course. And so if there are any interruptions or reductions of revenue collection, they do have sufficient liquidity at least to get them through short periods of disruption before there would be any issue with making debt service payments.
And Suzanne, that's one of the things your team looks at up front is making sure those liquidity provisions and everything that's in the bond documents are adequate to foresee interruptions, right?
Right. And, the history, even in times of natural disasters, is that there have been very few interruptions. But if you have a community that doesn't have power, then it's difficult to send out your utility bills. So that is not unlikely. But again, we would view those things to be very temporary interruptions, and that the utility would very quickly recover and be able to go back to business as usual.
In very different circumstances, but something that I think is high on everybody's mind in the muni market just after the COVID pandemic, when air travel was interrupted dramatically and airports that rely on ongoing revenues and operations faced questions about their liquidity. Again, they were generally adequately reserved, but it was something that really brought home that these are real world risks. Todd, as Mike noted at the beginning, more than half of the BAM-insured bonds in the Los Angeles area are general obligation bonds for school districts. How different is the disaster risk analysis when you're looking at those bonds?
School districts in California will issue voter-authorized unlimited ad valorem property tax bonds to finance the construction of voter-authorized projects. The source of repayment on those bonds is a property tax unlimited in rate and amount that is levied on all taxable parcels within the boundaries of the district. Unlike an abatement lease where the source of repayment of the bond is directly linked to a specific asset, or a special tax bond with a dedicated but limited revenue stream derived from parcels within designated boundaries, these bonds are payable from property taxes levied district-wide, and they're not exposed to a single building or parcel, and there's no limit on the rate or amount of property taxes that may be levied to repay the debt.
So, Todd, I do want to just thank you for being here today because you grew up in Los Angeles. You still have family members there. I know this is personal for you. This is going to be a long-term rebuild on these communities. What do you think comes next? What are you going to be watching for as somebody who knows these neighborhoods really well?
Well, listen, the second installment of property taxes are due on February 1st and become delinquent on April 10th. So the immediate focus right now is on any near-term relief packages for impacted property owners. For example, we're looking for any relief on the obligation to make timely property tax payments. Over a longer term, things we're looking for include the reassessment of property values for parcels that have been impacted and how that rolls into 2026 and beyond. There's a lot of uncertainty in the near term, but that uncertainty is going to roll forward as well and impact the timeliness of tax payments, but also the amount of tax payments.
And that property tax adjustments to the due dates, would that come from the state? Where should people be watching for that to?
The county levies and collects property taxes in California, so Los Angeles County will address that matter. However, we expect and anticipate a coordinated response at the federal, state, and local level. The scale of the relief packages is unknown, and there are a lot of anxious Angelenos waiting for that news.
One thing, it's a little counterintuitive when we talk about disasters like this, but one thing we've seen played out over and over again is that once rebuilding activity starts, that actually can provide a temporary boost to economic activity. There's a lot more sales tax revenues as people are buying building materials and things like that. Is that something that you'll be watching to see if it's in play here?
It's a good point, Mike. There's some evidence to suggest that will happen again here. However, we're likely to see a lot of discussion and debate about how to rebuild in areas that are prone to wildfires. Do we update building codes with an emphasis on resiliency? Do we replace like for like? Any changes are going to require a coordinated effort among a variety of governmental entities, so there are no easy answers. Both of the fires that we're focused on immediately, the Eden and the Palisades fires, are in known areas that are prone to wildfire risk. The scale and severity of those events is changing. We're all anxious to see what the ability and willingness is to rebuild in these areas.
I think something that's also interesting to note is that the area already was suffering from a housing shortage prior to these events, which is now only exacerbated and in fact may drive up, and we've already seen evidence of driving up real estate values and rental prices for housing outside of the affected areas.
That's a great point. Suzanne, we've been focusing on the local impacts, but as Todd just mentioned, given the scale of this, it's probably the most expensive natural disaster in U.S. history. There is the potential for much bigger credit impacts on the region and the state. What are you going to be watching for on that front?
Well, I think a lot has to do with the availability of property insurance going forward. For a long time, the insurance regime in California had insurers looking at their history of claims when determining their rates. But recently, legislation was enacted that allowed insurers to factor risk-based premium rates into their schedules. It remains to be seen what will happen following a disaster of this magnitude. As we've seen in many news articles, there were a number of homes in these communities that didn't actually have wildfire insurance anymore. And that reflects the point that Todd just made, which these are high-risk areas. So I think a lot will depend on the availability of insurance, both for homes and for commercial buildings and businesses. I think there's going to be a lot of discussion on the role that the state could play in availability of insurance. We've seen in other states, both Louisiana and Florida, have state-run insurance programs that provide insurance in markets where private insurers are unwilling to participate. And so that may be something that we see come down the road here in California. I also think we're going to be looking at what the impact is on the cost of living here. How affordable will taxes be? How affordable will the debt be on reduced tax bases, at least in the short term? But as you alluded to earlier, it's entirely possible that we'll see values run up a lot based on demand for homes and based on the demand to rebuild. So I think it's something that we're just going to have to keep our eye on and monitor closely.
Thanks. Well, thanks, Suzanne. Thanks, Todd. And thanks, Mike. This is just the start of a story that's going to play out literally over the next decade, as we've highlighted, and we appreciate everybody's insights on what to watch for. Thank you for listening to this episode of the Muni CreditCast from BAM Mutual. There's a new Muni CreditCast on the last Wednesday every month, so subscribe wherever you get your podcasts. BAM Mutual is rated AA with a stable outlook by S&P Global Ratings, and we insure more than $125 billion of municipal bonds from across the U.S. For more information, please email us at creditinsights@buildamerica.com. And again, if you have any specific questions about BAM's exposure to the wildfires, please reach out to ir@bambonds.com. Thanks.